Today is Friday, June 28th. I'm going to go over some of the weekly trades that I placed. Beginning of the week, mostly earnings. So ACN, that read as a strong bullish Tenkan Kijun. However, there's a sharp decline ahead of earnings, and the RSI was overbought. So this turned out to be a very profitable strangle. And as you can see, once earnings hit, implied volatility plummeted predictably, and it did have bullish lead in the Tenkan Kijun, sharp decline ahead of earnings, but then it rallied and looks like it beat earnings. So earnings were after market close yesterday, and it was sharply up before earnings, and looks like today it's opened up 0.46%, but the main thing is the decline in implied volatility. So I have a strangle that's a 177 put, 192.5 that's expiring 100% worthless. Those are about the 20 deltas, so that is a good trade. I'm going to mark that as good, and that's where the Tenkan Kijun bullishness forecasted earnings beat. So next, expiring this week, BlackBerry. So BlackBerry, I have a strangle on there at 7.5 put, 9.5 call. The put is in the money, so looks like they probably missed earnings. Yep, big plummet. They announced before market. That was on 26, so they had a huge plunge that day and then following. So the put went into the money. Implied volatility has gone down. It was pretty heavily overbought before earnings. And as you can see, it was mostly negative Tenkan Kijun earnings. That Chiku stayed below the Tenkan Kijun, and it did have a slight dip before earnings, but the main thing is that bearish Tenkan Kijun forecasted an earnings miss. If you had to have additional confirmation, it was overbought into earnings, so that's usually a sign of irrational exuberance. And the Tenkan Kijun did peak up right before earnings, but the overall trend, as you can see since last earnings, was bearishness. So that forecasted an earnings miss. Selling the call was 100% profitable, 97%, but that resulted in an overall profitability for BlackBerry at 52%, mainly due to the drop in implied volatility. So the next one expiring is FedEx, and that was just a straight short call, and that's mainly because of the news with China that they're going to have to monitor the packages. That seemed like a major headwind to their profitability. But let's look at the technicals. So with FedEx, since their last earnings cycle, slightly more bearish than bullish. Obviously it went up here bullish, but overall bearish. Chiku stayed below. There was a slight tick up right before earnings, and you can see some harsh bearish sentiment going into earnings, and as recently as 3 days before, it was overbought. They announced earnings after market close, June 25th, and it actually has been up quite a bit since the earnings. That's surprising. Look at that, it's kind of rallying actually. So I wouldn't say that they missed earnings, really. It looks like they beat earnings. even though they had pretty negative guidance. However, selling that 20 delta call still won. So it didn't hit 167.5, and with the drop in implied volatility, it lost a tremendous amount of value. So even though it beat earnings, it still didn't hit the call that I had sold. So that resulted in an overall profit of 98%. SNX. Well, actually, let's make sure I'm not missing anything else. So FedEx. Then General Mills. So they actually, it looks like they missed earnings. I guess they announced, before market. So you can see their stock plummeted, but now it's heavily on the rebound. Stochastic wasn't very helpful in this one, other than to tell you to, always get out when the stochastic goes above 80. It did go above 80 over here, and you would have wanted to get out, get back in when it dipped down, get out again over here. Now would be a good time to get back in, perhaps, although I'd like to see it go down even more. But General Mills, that had been all over the place since the last earnings. Slightly up, and from the low point over here, of course, but they still missed earnings. But then again, this is where you can find bargains so oversold. And General Mills, the strangle that I sold with a 50 put and 57.5 call, came pretty close to hitting the put. However, it's going to expire 100% profitable. So, this is a July expiration, but it has earned me. I could take off that call, the short call. That's 91% profitable. Keep the short put on. That's gaining some value back. But what happened was it resulted in a 64% profit. So we'll take that. Next, we have MU Micron. So Micron, profitable. Oh man, negative 732%. That crushed it against me. That was okay, here's what happened. I accidentally sold 2 short calls. I meant to. I was doubly bearish on that one, and they just destroyed earnings. They killed earnings. They did great. And looking at the charts, it'd be hard to tell because it was predominantly bearish since their last earnings cycle, but for some reason they really, really beat earnings. It must have been aftermarket close on the 25th. Yep. So the next day it just opened higher and it kept roaring. You can see that going in, it was quite oversold in earnings, both with RSI and stochastic. So that helped, but selling at 35 and 36 calls are both way in the money, and that results in an enormous loss of negative 741%. So I'm going to take some notes on that. And lastly is Walgreens Boots Alliance. So not majorly, but predominantly bearish. Looking at the Tenkan Kijun, mostly red since last earnings. Going into earnings, slightly oversold, so that is a bearish sign. And maybe that's the indicator to look at. They did beat earnings. but not enough to approach the call that I sold 20 delta, so therefore that is going to finish at about 100% profitability, as the implied volatility has been completely obliterated. So yeah, look at the RSI and the stochastic. That's the lesson.